Oh, that's it, man.
That's supposed
What?
You're not supposed
I was cheering. I was cheering.
You can appreciate it.
Oh, my God. Was that good or what? Welcome, everybody. How you doing? That was Arturo Sandoval, by the way. If you're a longer-term investor, let's have some fun here. How much do you want the stock market to fall when, and inevitably it will, fall? How would you answer that question? To me, I want the markets to fall enough to where my forward performance results, add up to a highly probable chance of a profit. So if that means that the stock market needs to fall 10% for me to have a high probability of having a profit 1 year later, I'll take the 10%. Would you?
Yeah.
Okay.
Take the money.
What if I say, if the stock market fell 10%, there's only a 65% chance that it will be positive for you 1 year later. Would you do that?
If it fell 10%.
Yep.
I'd stay in.
Okay, so now let's say, all right, the market falls 10%. There's a 65% chance that you will have a profit 1 year later. 2 years later.
Yeah.
Oh,
2 years, though?
2 years. I changed it.
90% chance.
Good catch, by the way.
I think I'd stay in.
Okay.
That depends on who it is, though. How old you are, how close you are to retirement. Like that could really change depending on who you ask.
Baby Jazz with the knowledge.
So how far do we want the markets to pull back? Now, I get that this is tough. This is a difficult thing to watch the market fall 10%, 15, 20, 25%. But how far before we realize that the probability of a positive return going forward is so great that we have to cheer this pullback on? So hang with me. Here's what we got. So we are literally, we good? We are literally looking at every single decline in the market. Now, let me play with this for you for a second. So what I'm looking for here is we can only identify a decline as a pullback from a high. So we had to have gone some distance and then pulled back. Okay, let's mark that. Then let's find another one. Let's mark that. So from right to left, what we're saying is how far did the market fall from highs? So in other words, if we move to the left here, we fell 10% from the highs. Then what we're saying is, on the y-axis, what's the return over 1 year? So just to illustrate this, if I go over to a 10% decline, you have about a 50% chance of a gain and a 50% chance of a loss, right? Over 1 year. So if the market falls 5%, it's kind of a coin flip. If the market falls 10%, it's kind of a coin flip. You can see that as you work your way over, oh, now we've got something here. If we fall, this is a lot, but if we fall over 20%, 25%, now we have a greater number of scenarios where the market was higher 1 year later and less number of scenarios where it was lower. If we work our way down all the way to 35%, there are 0 times where the market was lower a year later. Now, I don't want, personally, I don't want a 35% decline. But what I'm looking for is that sweet spot where we go, well, hey, where do I really salivate and want to be up? Let's say Trump wins tonight and all hell breaks loose and the markets just fall apart. Okay, fine. How bad do I want it to fall apart? As quickly as possible. I'd like it to fall apart 25%, right? And that's going to be stressful. I get what's going on there, but I know the odds are that I'll have a return a year from now. I want to buy into that dip instead of sitting there and staring at it or being nervous about it, right?
Yep. I was trying to find some stats for you here with that. So I was working on some things.
Oh, okay. Well, then I'll keep moving on. So let's go even further. The longer term investor you are, the greater probability of success that you have, meaning the probability of you having a profit after your starting point. You know what I'm saying?
Which is why you should start when you can. Start as young as you can. Full circle moment right there. Just,
you know the saying? When's the best time to start investing?
now.
Nope. The best time to start investing was yesterday.
Oh.
The next best time is today. That's not mine, right?
It's fancy.
Even still,
Yeah.
that's the whole premise of the Dove Straight channel, is so you have these opportunities here. You see the market fall apart. You just said your best bet is to be the longest term investor, so you can participate in this. Just kind of going with the flow there. There is a solid point to that. I'm very much an advocate for getting started younger and getting started as soon as possible. So I feel like that was good. Why are you looking at me like that?
I was going to say, you get this lady a drink and she's deep. She's ready to go.
I took one sip of this thing.
Okay, so let's go a step further. Now you go, well, I don't care. It's a year, right? If the market falls 25%, I don't have a year. I have 20 years to invest. Well, okay, so let's go out a step further. Let's say if the market falls some given percent from highs, what does a 2-year return look like? And it gets a little bit better. So I'm going to go over to, you got it. So now play the same game. So we'll start at the flat line here. We'll say if the market falls 10%, what's the probability that it is higher or lower 2 years from now? Well, it's not quite 50-50. We've got more scenarios up here where we're positive and less scenarios where we're negative. If you go to the same 25%, almost every single scenario from that point on is positive 2 years later. So I'm going to point this out mainly to clients. At some point during our relationship with Jazz Wealth, the stock market will fall 25%. It's just going to happen. However, now you know that that is an opportunity to utilize cash that you have in your portfolio, which currently we do have cash in our portfolio, to invest in the market. And it doesn't necessarily matter if you guess the best bottom possible price. If you're using that decline, significant decline, to invest cash that you have and or rebalance into positions that have fallen, you will be better off 2 years from now. That's just 2 years, most likely, than you will be, at that moment. I don't know how else to say it. By the way, so everybody can see this, look how amazing Chris looks. Look at him.
I know.
Really
Yeah.
is.
Somebody take a picture.
You look like you're on CNBC or something.
We don't
I'm
need to take
impressed.
a picture, Chris. We're recording it.
It's going to be archived. Yeah. You look amazing.
Somebody said, they would vote for you too. So maybe write in if you haven't voted yet. You're in a state that's still going here.
We'll see how much gray hair. We'll see how much gray hair I have in 4 more years.
Hit me with a smile, Chris.
Man, that's a presidential smile right there.
I would like it to be noted that Alex said Chris looks like our local Aflac correspondent.
You got him. He almost spit out his drink.
That's good. That was good. All right. Jabba D's Huts.
Great name.
Huts. You asked who it was that said it. That 5% decline in a day data.
It's just not.
Really good info.
Hat tip to that guy.
It's just not what I thought you said.
He said, "'Tis was I."
Huts. Yeah.
Okay.
Wow, California, Washington.
It is 11 o'clock.
California and Washington are in.
So I'm going to share my last bit of data with you guys for tonight. This was based on what this person asked for. What does the market look like after a 5% drop? All right. So, and we're talking about 1 day here. So this is literally every scenario. So forward performance of the stock market after falling 5% in a day. Here is the day that it happened, right? Then we have the actual percentage drop, and I hope you can see that. It's a little bit, I know it's small. Anyways, here's to show that it was at least 5% or more. Then we look over the next day, week, 4 weeks, 3 months, 6 months, and a year. Usually we do things like this because we're trying to show both the shorter term and the longer term guy what things look like here. So over the next day, when the stock market actually falls 5% in a day, the average performance the next day is 2.11% positive, 82.1% of the time. I do not have the keyboard, so I can't zoom back out on that. If you look at any other 1 day period, the average performance in the market is 0.03%. So just an average 1 day, 0.3%. If you move forward over the next week, average performance, not as good. You got a lot of volatility inside of here. You can see some of the negative. Average performance is a positive 2.03%, but only positive about 68% of the time. As you move forward, there's a weak spot in here from 4 weeks to 3 months where we, maybe don't have the best of odds there. But whenever there's a 5% drop and you're looking long-term, the odds are in your favor there, where you have a performance or an average performance of 11%, 25%. And if you look at all 6-month periods and all 1 year periods, you have obviously about half of that and about, 38% of that or whatever. So what we're trying to show is if you just invested all of the time over a year, here's where you stand. If you waited for a 5% drop, your odds of a higher performance go up by more than just the average. I hope that makes sense. That's not, normal to talk about. Anyways, moving forward here. How often does that happen, and in what months do they actually happen? October has the highest number of 5% drops in a month, 9 since World War II, basically. And July and February, if you're looking for them, they're just probably not going to happen in that month, so it's not all that exciting. What happens if the markets gain 5% in a day? Not lose 5%, but gain 5%. Things change dramatically, actually. So here's every single day, and here is the performance that we have. The next day after a 5% gain is actually negative on average, minus 0.69% is your average performance, and it's only positive 34.8% of the time. Whereas any single one day, of course, is that 0.03 that we talked about. Over the next week, you have negative performance. In other words, when people see gains, they tend to sell or take some profits into it. They're not attracted to buying and supporting that decline. So we have a negative performance here over the next week of minus 1.67%, and it's only positive about 40% of the time. Over the long term, which is really what we're trying to drive home here, over the long term, your odds of success go way up, and your odds of outperformance go way up as well. Remember the same 9.1% there? We have a greater greater return in total of 26.9% by investing for the long term there. So really a different story. And if you're looking for the 5% gains that happen the most of the time in one day, March is going to be your leader. And I find it fun to show that October is also your second place, because remember, October has the greatest number of 5% drops. What does that tell you? Exactly what we showed on the closing beat there. October is always the most volatile month. There's no secret to it. We've talked about that numerous times on the closing beat, but there you have it there. And lastly, if you just wanted to see it on one singular chart where you can hit the screen share button, screen snap, or whatever you talk about there, green is after a 5% gain in one day, and red is after a 5% drop. In the short term, you'd prefer to invest during a 5% drop. In the long term, really long term, you'd prefer to invest after a 5% gain. Just depends on what you think, right? If you're a contrarian or you are, you see that? The camera guy is getting a little weak there. But just depends on where you're at. Personally, I'm a contrarian. I like to see that weakness, knowing that that plays out based on everything we've shared tonight, that, hey, buying dips makes sense. It's not going to feel good, and it may hurt for a while, but over the long term, it's going to work out for you. Thoughts, ladies and gentlemen?
Yep.
That was a lot of information, but
Thank you. Yeah.
that was, I feel like, answered Jabba's question very.
Would you change your outfit, for God's sakes?
He kind of looks
Where's
cool
the
in front of the
onesie?
American flag.
Yeah.
I mean, what a job right now. But
Look, you look great. I'm not saying you look bad,
all
but
this up.
I get to wear this once every.
yeah.
Okay. I get to wear this.
Is this what you wore when you
Once every
sold
4 years.
insurance?
Yeah, I did.
Said-
Yeah,
day.
I did.
I'd buy insurance from that guy. Looks good.
Let me
Yeah,
tell
I'd
you.
vote for him right now. I mean, look at him in front of the American flag.
All right.
Back
We're
on
doing
track.
some.
New
let's
poll.
do a fun fact,
Okay.
and then we'll do some exit polls.
Who do you think makes more money in the stock market, Democrats or Republicans?
I believe it is Democrats.
You think that? So as investors, like
As investors, I believe their trading has a higher percentage of wins than losses.
okay, let's take a look. So here we go. Here's the Democrats and the stock market. In fact, the Democrats do beat the S&P. You can't beat the S&P. You should just put your money in the S&P and let it ride forever. Not if you're a Democrat. You actually outpace the S&P by just about 7%. Well done, Democrats. Republicans need to get their act together. We have, what is it? Compared to the S&P, almost 8% difference. The black line that you see on the screen is the S&P. The blue, of course, is the Democrats, and the red is, of course, the Republicans. They are, and still this day, I know this is a little bit dated, to this day, they are still 15% behind the Democrats there. They need to pick up the game a little bit. You can actually track that. There are ETFs that you can use where Now it's delayed. This is not second by second. It's delayed, but you can actually follow along the trades that Democrats are making. There's a whole list of them. Nancy is the ETF name there because, well, it kind of started based on Nancy Pelosi. And Cruz with a K, Kruz. What?
No, yeah, it's based on her name.
Nancy. And how in the hell do you expect us to keep a straight face with that on, sir?
I gotta see. We gotta cut to Chris.
Here.
Can we get a cut
What's
to
going on over
Chris,
here?
please?
I can't see the camera angle, but
Is this what Swamp Rat looks like?
America. Yes. Go watch out for them. Watch out for them Gators.
Dude.
Wow.
And
Please.
just like that, everything went downhill.
Yeah, you just lost all credibility in one shot.
So I went from selling insurance to
Selling tractors.
selling.
Selling beer.
Not even tractors. Yeah, I don't even know, man.
Okay, let's see if you can do the next fact while in that and do it as if you are that character.
Ooh.
You got this.
I want to hear like a cool voice with it. Yeah, you can't be.
Come on now.
I'd rather just give it to you.
Give it to me like that person would give it. Who are you, by the
Oh,
way?
he is the Florida man.
Christopher Chet
That's
Plank.
the Florida man right there.
Oh.
Chris Florida man Clink.
Okay, hit me.
I'm going to tell you how we're going to do it in fact. Okay. So, one president won the electoral college unanimously. George Washington.
You,
A great American. I salute you.
He did it twice, it says.
He did it twice.
Did anybody understand what he said?
No, I don't know what he said, but I saw the
right.
slide.
There was
on the fly.
there was one president that won the electoral college unanimously. And that person did it twice. It was George Washington.
Can't think of a
And-
better man to do it.
Yeah, he almost, well, James Monroe in 1820 had 231 out of 232 electoral college votes. Well, and that was because one dude was like, hey, we're going to keep George Washington's name out of your mouth. So we gave it to him twice.
Is that like a Will Smith reference? Chris Rock, Will Smith?
Yeah.
They
Keep
say,
my wife's name out your mouth.
they say you got a wife beater on under there?
Oh, let's be honest.
John Joe says, is that the Jags quarterback?
No.
You know,
Cody, you know that reference. Cody's in there.
when you grow up and you don't know
Oh,
it's
the
called
butt.
something
Trevor
other than a wife
Lawrence,
beater.
You can't really say that these days.
Yeah.
But that's what you called it.
That's what
All right, Michigan.
So over the course of 1 year, if we take the possibility of you beating the S&P by having cash, which just means a negative return for the S&P, 31% chance that you will beat the actual market there. So not good to have cash for a long period of time. You can obviously see that the longer time you go, the less your probabilities are that you're going to beat the S&P, and that's because there's an upward drift, a natural upward drift to the S&P. If you go over the 25 to 30-year period, there are 0 times where having cash beat the S&P. I'm not saying you would do this, but it's just kind of fun to point out that if for 1 year's time you decided I'm going to be in cash, the odds are not in your favor that it's going to have been a good decision there. So before we get emotional, whether it's the elections, which nobody did, by the way, I'm not picking on anybody, but before you get a little emotional there, just know that the odds are not on your side. You're likely going to lose by having cash. You can have maybe a portion of your account in cash. There's nothing wrong with that. But to go to 100% cash and expect to do better is going to be tricky. And by the way, that goes all the way back to the inception of the S&P, 1928.
Anyways, what I was talking about. So whether you vote for Trump, whether you vote for Harris, no matter who wins, there's 2 main changes. One with an interesting twist that I was doing some research here on that I think is super interesting around retirement accounts and the rules around them in 2025. 401k contributions. This one is an interesting one to me because there's 3 points of change / not change. So 401k contributions are now increasing $500. So your new limit is $23,500. So we're going up a little bit there. But if you are over 50 years old, you have a catch-up contribution. That's not changing. That is staying at $7,500. So you would be at 31,000.
Okay.
What I think is really interesting is that the IRS even added an additional catch-up contribution for if you are 60, 61, 62, or 63 years old. One of those four
A little window. Yeah.
Yes, a teeny tiny window there. Your catch-up contribution is $11,250. That I thought was so interesting is that's a new thing that they're adding in 2025 that they are just throwing in there, totally under the radar. So that's interesting. 401k contributions as a whole increasing, the catch-up for over 50 years old not increasing, and a new little bonus there for those between 60 and 63 years old. I thought that was interesting.
And that's new, by the way. That did not happen before.
Totally new.
I had a call on that today. Somebody said, hey, I'm looking to bump that up.
Yeah. So the other side, look at me. I'm ahead on this stuff. I know these numbers.
on it.
Okay. The other side of it is Roth IRAs. You know, you can only make a certain amount of money to contribute to a Roth IRA. If you make too much money, you can't directly contribute. Those are increasing as well, not by much, but they are. So in 2025, your contribution limit for a Roth IRA is not changing, but I just smacked the
You got this.
microphone there. But the income limit to contribute to a Roth IRA is for those that are filing single to fully contribute to a Roth IRA is $150,000. So anything below that, you're good to go. Partial contributions from, or if you're filing single, you can only contribute a certain amount, is between $150,000 to $165,000. So this is up about $4,000 from this year. So that's cool. Gives a little bit more people extra room to contribute there. And in anything above $165,000, you cannot contribute directly at all. The married side of that, married filing jointly, those words always confuse me.
MFJ.
MFJ. Okay, that's cool. Your base contribution is $236,000. So this is going up. I think it was $230,000 for this year. So that base is $236,000 to contribute the full $7,000 or $8,000 for your catch-up. And that phase out cap being $246,000. So interesting little points there. Tiny changes that they're kind of throwing at you for 2025 that at least I thought were interesting. And this is stuff that I like to pick and poke at. But two main changes there. Feel like it's good to know, especially as we approach the end of the year. Even just double checking your AGI for 2024, knowing if you're in those limits or not, and then what to expect for 2025.
Did it, girl.
Just got to point out real quick, Maslam here, talking about Gateway Computers out in South Sioux. I actually spent some time there as a kid, and I would intentionally buy brand new socks, usually dress socks, because I would go into that factory. What?
That's like socks.
I do love socks.
Here, sight
Good,
right here.
fresh.
I do love a good pair of socks.
Make sure.
Yeah.
He loves socks.
Right.
It's ridiculous.
Yeah.
And
Scoot over, Eric.
It's ridiculous.
You're like,
New socks.
come here, man.
these two. So I would put on new socks because in their little manufacturing facility where they would put all the computers together, they look like cows, by the way. Gateway Computers had a cow. And I would run and then slide as far as you could imagine on that smooth, slick floor in South Sioux City. So anyways, just wanted to point that out because I saw that comment there. Good old Sioux City.
Michigan.
You know how we have clients that will be in nest egg and we're like, hey, what are your goals? I want to buy a house. I'm going to, I need to buy a car every 5 years. We go through this and we try to work with people. And every time somebody has these goals, they're like, oh, my kids, I want to pay for this or that. And in my head, I think, why don't you put that you want 365 pairs of socks each year? How much could that possibly be? And then each year you donate your socks and then you end up with 300. Like that's going to be a goal for me. If we ever meet, like if you did my plan.
You just said you're going to donate socks, like used socks.
Yeah. Well,
It's only, you only use
they're
them
used one time.
Yeah.
But still, that's kind of weird. I mean,
No, it's not.
I don't know. Like I don't know if you would. I don't know if anybody would take them. Does anybody else donate socks? I want to know. If you're listening, do you donate socks? Have you ever? I donate a lot of clothes when we get done with them. We'll
New
donate
poll.
them. Is it weird to use socks?
Cody's going to start a new poll. Nope, start a new poll. I just ended the other one, start a new poll there. It is not wrong to donate a one-time used pair of socks to some person or kid or family that could use them.
Or drop them off at the Goodwill. Hey, here's 365 pairs of used
Okay, one person said no, it's not weird.
No, we're doing a
put the-
poll. We're doing a poll.
Doing a poll.
You have a poll going?
Poll it.
But I'm just saying, like, if you, I don't need a fancy shirt. Chris looks great over here. I don't have a shirt like that.
Not
But-
even a little bit.
If I could have a brand new pair of socks, the right pair of socks every day, I'm not sure I need anything else. I'm happy.
You know,
A
Goodwill.
little tear to my eye there.
Model.
You know?
Goodwill's whole business model is people donating inventory.
Yes, help them out.
But socks? I don't know. I think they probably have
For
cheap
one-
socks you could sell.
For one-time use, though. If
And
you
I
wore
work
them
in
a
an
bunch-
office. One time use and I'm in an office.
I think that nobody knows though.
like-
I don't know how you decipher. Oh, these were only worn one time versus these were worn.
You ever bought shorts from a thrift store?
That's a lot different.
How do you know if they're wearing underwear? You don't know.
You know,
That's true.
I make my wife wash everything. She loves thrifting.
I mean, you have to buy socks from somewhere. If people don't have the funds to buy socks and they need to go thrift them or get them donated, they got socks on their
How
feet.
dirty are your feet that you're worried about socks?
He's a germaphobe.
Yeah, I think it's very strange.
It's a germ
He
thing.
washes his plastic forks out of the drawer
yeah.
before
Oh,
he
yeah, yeah.
uses them.
Well, I've seen
Eric
people like
is a
reach in and
germaphobe.
grab them
You're a
and then put them
germaphobe.
in there.
Everybody should know that.
Now you know, Eric, a red-blooded conservative germaphobe, like total conservative. You know what I mean? Like
Now let's go to the.
needs some germs taken out of his life. Side topic. This came up the other day in the closing beat, and it was like, I'm not really, trying to address that. We were trying to focus on something else. Should you use a Roth IRA or traditional IRA? How do you determine, like for everybody that's watching that's still sticking around here for this, how do you determine at what point do you put money in one versus the other, even year by year? So I don't even know if Chris has seen this. Did you quit stealing my mouse? Okay, check it out. This is going to look like a lot. Hold tight with me here. What we do is we try to balance the advantage to the Roth or the traditional IRA. And we're doing it by current tax brackets. We'll adjust this when the, assuming the Trump tax credits sunset here next year. So we'll do it then. But what we're doing is basically saying, hey, look, if during the years you're contributing, you're in the 10% bracket, and then you're going to be in retirement in the 10% bracket. I get that there's some variables there, but if you think about it as, well, I know how much I might want to have in retirement, and so what's that income look like? What bracket would that put me in? I get it, the brackets could change, but for the moment we're working with this. Well, that's an equal split. If you are in the 12% bracket while you're in your contribution years, but then you're in the 10% bracket in your retirement years, you need to be using the traditional IRA. And that makes perfect sense, right? It's pretty obvious. And to go wild on this, let's just go, you're in the 37% bracket in the years you're contributing, you're making good money, but you're going to have dramatically lower income in retirement. Then you go, okay, well, there's a huge difference. The actual percentage difference in the amount that you take home out of your account is 30% difference. So, and that's pretty obvious. But where it gets a little tricky is when you're like, hey, I'm earning more this year. I'm going to be in the 35% tax bracket. However, I want to spend a little bit when I'm retired. I'm saving more than I should be saving. I expect to be in the 22 or the 24% bracket. You can see how the advantage towards having the IRA contributions is not as much, but still very, very helpful. It's not until you start breaking over here that your advantage is being in the Roth. So this is one that has nothing to do with elections that I thought, okay, let me just take a second here and just actually put that out there so you could screenshot it, do whatever you got to do. And as your income changes, just reference that. It's really simple. And I know it's an oversimplification of a really complex financial sort of picture, but that's a starting point, especially if you're younger. That's why I asked you guys his age earlier. I'm like, well, how's that going to add up there? Here we go. Here are the 40 bestest days in the stock market.
Bestest?
Bestest.
Bestest.
It's almost 11 o'clock. We say bestest. So in a table sheet format, we're going back to 1999. We're trying to look over a long-term generation of investing here. I know it doesn't sound like a lot, but it's 25 years. So we have each individual day's best performance. All right, cool. Notice over here, we have 2008 and 9, ooh, nasty. 2008 and 9, 2008, ooh, nasty, right? Then some COVID days in here, then some more 2008, ooh, nasty. Well, it's during the financial crisis, right? Where the world was technically supposed to end. Fun fact, by the way, I'm going to go back to this for a second. Black Monday. You know the history of that?
87?
Yeah, but there's actually a sort of a small documentary made on this. One guy stopped that crash from happening because there was such a calamity going on. He was across the street from the Chicago Trade, and he's like, if the world is ending, then money doesn't matter. So I can just go buy as much as I want. He put on his trading jacket. He walks across the street, goes in there. He's like, buyer. And he buys every single thing that people would be willing to sell to him because he didn't think it would have any value. They all thought this was the end of the dollar, the end of the world. So one guy literally stopped the bleeding because he thought, nobody's going to come after me if the money's not worth anything. So I'll just take as much as I can get. He did well.
I'm curious what his profit was off of that whole deal.
And they did a whole documentary with him, and I'm like, what a brave guy. Anyways, so if you look at the best,
You want your quarter.
that's the guy you want right there. So here's the 40 bestest days in the stock market over the last 25 years. Do you think it matters if you miss the 40 bestest days? I keep saying bestest
Yeah,
too.
why?
We're going with this, right?
You might as well say bester.
These are the, is that a fire in the background? No.
No, there's
Lights.
So, I mean, these are impressive days here. We've had some good ones. You might be old enough to know that a lot of these days came after some horrible down moves during the financial crisis. I lived through it. I traded through it. It was a blast. So anyways, here we go. These are the 40th best days. Now, let's say that you said, oh my God, I am very worried about the financial crisis. I'm very worried about COVID, more financial crisis, COVID, blah, blah, blah. And you decided to stay out of the markets. Well, we take that breakdown and we say, all right, if you miss the best 40 days out of all of this here, in the dark green up at the top, we have the S&P's total performance. If we go down to the orange, which is the 40 best days that you could actually have, or you missed the 40 best days there, you have a considerable amount less. Let's just go in order. The S&P, the value of a $100,000 investment turns into $662,000. Great. That's if you did nothing. If you only missed the 10 best days, just purely the best 10 days, you now have an annualized return that is half, and a total return that is more than half of just being in the market. You better be pretty sure about those down days there, which leads to a study that I did a while back where we talked about if you were going to hedge your portfolio, how accurate of a hedge do you need to be? Turns out you need to be like laser accurate on these hedges, but that's a separate topic. If you miss the 20 best days in the stock market, you would have an annualized return of 2.55% over 25 years versus the annualized return of about 8%. You can see how it just gets worse from there. If you miss the 40 best days in the market, you have lost money. And it's so weird to look at that because if you miss the 40 best days in the stock market, but they came after some really bad down moves, you'd think that you'd be okay. No, you actually end up with a loss of 0.76% per year for 25 years. And if you miss the 50 best days, I don't know why that's in there. You actually have an annualized return of negative 2.13% for 50 days, just for fun. Let's go, this one's got here. Okay, let's go. So there are 272 days in a stock market year times 25 years, 6,800 days, and all you did was miss 50 of the best of them. I know that's probably not likely, but if that were the case, you had a negative return for missing 50 of 6,800 days. Hate to see that. Be very careful what you decide to do with your cash out there. You know what I mean? So we did this on the closing beat the other day. If you weren't around, check this out. So in election years, through the end of October, what had the market done? So for example, in 1928, so as far back as we can go with the S&P here, we have 22.76% from January 1st to October 31st. And we were looking to see, like, how odd is it to have a 20% rally in an election year right before the elections? You can see that it's actually very common in election years for the market to be positive. There's only 4 times in election years where the market was negative going up to when November started. But we're a little bit ahead of schedule here. So we, as of the end of October, we had 19.62% return. That would rank as the 3rd best performance in an election year, year to date up to November. So we're a little bit ahead of schedule. The average is closer to 11% in an election year. I'm sorry, 9%. I said 11%. 9% in an election year, although positivity tends to be prevalent, right? It tends to be what happens. There's only a handful of outlier years to the upside and the downside. So the point here is that when you look at those years and go, well, why are we up so much? It's actually pretty common to have a quite positive year going into the election results. However, 20%, no, it's not actually that common. So we'd be just a little bit ahead of ourselves. And if I can find it real quickly, what I want to point out is the S&P, I shared this on the closing beat the other day, the S&P is actually way ahead of itself relative to its average. So I joked in our letter that we write each weekend here that the, Wisconsin, 8% in. Okay. Pennsylvania.
27%. We're making our way. Making our way.
All right. Man, I wish I wouldn't have played both sides there.
So we don't have that streaming though. So we need to, like, when we're seeing it, people are probably like, what are they saying? I mean, they may be streaming it at their house too.
Yeah, you might have TV on there.
There's also a little delay on this side. so
Georgia's
they'll
now
see that first.
52% Trump, 46% Kamala, with, what was that, 60, 70 something percent in?
70% in.
Yeah.
So anyways, the S&P is actually outpacing itself right now. So in the last 1 year, not only have we rallied more in an election year, year to date than we should have, but we also have a 38% gain over the last 1 year, not this year, just one total year. And the average 1 year gain for the S&P is about 12%. The average 2 year gain for the S&P is 10.7%, but yet our 2 year rolling gain is 23.3% a year. So we're well ahead of schedule there, or well ahead of the average. In other words, the S&P is in fact beating the S&P's average. If we look over the 5-year period, the average annualized 5-year return is 10.5% per year. And this goes back to the very beginning of the S&P. And 15.3 is where we stand as our 5-year return, not every year being positive, but we have a 15.3 annualized return. So in other words, what I was trying to show is we are ahead of schedule there, and we're ahead of schedule here. Whether you want to look at election years or you want to look at, just the S&P in general, a little bit tricky to suggest that now, I mean, I feel this way, but it's a little tricky to feel that now is the time just to bet everything you have, and go all in the market when it's clearly running at a hotter pace than it normally does. Eric, thoughts on that one?
Well, you did just say don't leave cash on the sides too long, right? So should we put it in the market or put it in cash?
Oh, is this because of that Democrat thing I said?
What? Coming at you.
Yeah.
No, I think you have to realize that, I mean, truly, we've talked about this really for the whole year. At some point, there's got to be a pullback. The Fed starts to cut rates, but they say that the economy is still strong. Generally speaking, the Fed only cuts rates when the economy is actually starting to, look a bit worse, because when they start to reduce rates, that means that, okay, hopefully if we reduce rates, the cost of borrowing is not going to be as expensive. That can allow companies to expand and be able to borrow and to continue to grow. We're in an interesting spot here with what we've got, because we do have a market that's running hot, and per Uncle Jerome Powell, by the way, he's not my real uncle. I had somebody I talked to again today. They really think that he's my uncle,
come on.
We joke. So and I don't know. Maybe I have to say that. Maybe he really is, but I don't want to.
Did you look it up? You should look it up.
What if he is related to me somehow?
Give him a call.
I have no clue.
Got a teeny bit of similarities there.
We do.
A little bit.
If I shave my head, I have pretty big ears too. So,
see.
but yeah,
Ears and a long neck.
and a long neck.
Not the long neck.
And all the words that, no, I'm just kidding.
All right, going back to this scenario though, if we're looking at everything as far as, at some point the market has to take a breath, and we have not seen the market take a breath. And so, yeah, I agree with you. Looking at this chart, what the newsletter that we talked about this past week and what Dustin had shared, the idea that at some point this market has to take a breather, and that's where I think we're at.
Finally.
Steven says, so if there's a black swan event like the COVID drop and you have cash on the side, how do you decide what to put it in? Just go with SPY. I think that's really going to depend. I'll let you weigh in too, Dustin. But I would say on scenarios like that, it depends on your comfort level, because, in the COVID time, everybody was like, buy the cruise lines. And finally, Royal Caribbean's soaring now, but it took years for that to really get to where it was soaring. And so it's one of those that if you're willing to take the gamble or the risk on a few of these, look at company valuations, really starting to say, okay, these stocks just sold off just because, not because there's actually a problem. Potentially you buy some of those stocks individually if you're wanting to play it more safe and the market overall does pull back. I mean, something like SPY, the S&P 500, is not a bad option for you. I don't know if you have any other takes on that one.
Well, it's tricky, right? Because some people say, I don't have the time, I'm not interested, or I don't have the skill set to go buy individual stocks. I don't blame you, right? If your forte is building pools, you go build the best pools you can build. You're not supposed to know like what stocks you're going to pick. My forte and our forte here is the stock market. That's what we love. So I can't build a pool, right? I'm going to get a guy to do that. Well, if you're saying, I don't need a guy, I don't want a guy to invest for me, you're probably right. You're going to look at something like the S&P. I might argue that you look a little bit deeper and go with the S&P 600 and or the NASDAQ, depending on how young you are, because you might find performance is a little bit better there. Now, if you're an individual stock picker type person, well, when the markets fall, you're not going to find that everything falls together. Even during COVID, remember that didn't happen. Not everything fell together. So it's not as easy as just to say, take $1,000 and spread it across all your positions. So you're going to look through and go, well, I'm willing to be heavier in things at the time during COVID, like Marine Max. We're going to go boating more, right? We're going to go to Camping World. We're going to RV more because we can do it by ourselves. Maybe you take that sort of short-term risk there, but I would say most people that don't have this as a specialty are going to say, give me an index. And I'll go one step further. Maybe you know enough, you go, well, the index is fine, the S&P, the NASDAQ, the S&P 600, whatever, but I'm also partial to utilities or oil or retail or tech or communication services. You could also do some kind of sector-based ETF there as well, if you wanted to. Nope.
If Tron 1221, with the safety stops in place nowadays, can a crash really happen? Absolutely, because crashes aren't going to happen possibly in one day, just a massive market tank in one day now, but it will happen over time. So the crash is really one that's going to take multiple days, if not, a couple months of a pullback where you're going to see that decline in the market. So it's not something that could just, happen randomly in one day. That's kind of your breakdowns there.
May 10th, 2010. I could have been broke forever. Never had another dollar to my name. I got lucky and had to take my mother to the airport during what they call the flash crash. Had I not taken her to the airport, I'd have lost everything. Guaranteed I'd have lost everything. If you're familiar with the flash crash there, I was actually teaching and training, and I'm like fascinated by Wisconsin right now. But I was teaching and training Chinese investors who they like to gamble a little bit, they like to go for it. And we would have went for it on that day and I would have lost everything. Guaranteed. It would have been the end of me. I wouldn't be here right now. So crashes can happen in one day. We have circuit breakers, of course, the 15 on, 15 off thing like that. But that doesn't mean that we can't open back up and crash another 5% and then they shut down the market. So it's possible. But I wouldn't expect that in one day.
Yeah, I was trying to find the stat here. It says, so you have to be it's tricky when you're starting to look at, the amount of points that drop in a market, because the news will grab those headlines. And this is just an example here. February 5th, 2018, Dow plunges 1,175, worst point decline in history. But points are different.
Yeah.
Drastically now than it is, percentages.
Yep.
So you've got to be careful what they're saying here. Though I was trying to find the drop amounted to 4.6%, biggest decline since August 2011. I believe this was right when I had launched because I was an advisor for a while prior, ended up going out on my own prior to merging with Dustin back in 2018. I had just launched my business and all this just kind of fell apart.
Crazy.
because 2018 was not the best year for the markets. And I was like, it would happen that year. Let me go real quick here. So I finally found these stats, kind of going back to exactly what you were showing in the chart there. This article is from 2022, but it's I was trying to find everything that showed exactly. Schwab did a really good one showing the breakdowns on how often things happen. I could not find that one specifically. This says a correction or a 10% plus pullback happens once every 2 years on average. Bear market is once every 7 years, which is 20+%. And then, as you mentioned, a 25 or more, really even a 30%, that would be considered like a crash, is once every 12 years on average. So it's kind of just shows you, we're talking once every 2 years. I mean, we're going to get a 10% pullback. We haven't seen that in 2 years. So we're due.
What rain dance do I need to do to make this happen? We covered a lot, and I only got through about half of what I had to cover. So
to wrap this up, you got to tell people how many years is it going to be before we do this again. So we gotta get this wrapped up.
what?
You were
4 years?
Oh, I'm thinking we do.
Next week?
Every 4 years is the election, so I'll never forget it. I thought you'd throw me a 4, man. You always
4, baby. Yes, that's what he wanted. I know it.
All right.
Adios.